right, we'll get started here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Happy Friday, Kirk. Good to see you again.
Happy Friday. It's not as good of a Friday as last week, but it's still a good day. It's 70 degrees out here, and it's a very nice Friday.
It's definitely not a good Friday.
Well, cool. So, yeah, not much has happened in the last week. Not much to talk about. Well, except for the fact that Trump says the war is over. You know,
Ta-da! Praise
we're
Jesus.
done. We won.
Yes.
We're going home. I have to say, I think this is all just pure comedy. I mean, if I was putting together a show or a movie, this is exactly how I do it. I mean, I have to say, I give Trump an A+ for masterful choreography and persuasion and making it interesting to follow, albeit very predictable, like the movies of old. The movies of old, you could always tell what was going to happen because it was so predictable. So when there was a movie that didn't follow the script, it was like, whoa, that's a good movie. It's different. But yeah, I have to say it's been a very interesting week. You know, Trump came out and just said, hey, you know, we're having a deal, 2-week ceasefire. And, you know, I guess yesterday was the original deadline of the 9th, but, you know, he said, all right, we're giving him another 2 weeks. And then you hear other news reports of the fighting still going on. I don't know how Iran is going to negotiate when they've got all these different people that are managed by different people and there's no leader anymore. So who's managing it? I don't know. But to me, it seems like Trump is buying himself time so the market doesn't melt down, is what it seems like to me. You know, it was a big week for news, you know, for inflation, for Fed speak and all this stuff. And it didn't seem to impact the markets at all. The markets really shut up 3 days ago on the news of, you know, everything's okay. We're going to get a ceasefire for 2 weeks. I'm not really sure if this is positioning or not, but I think we can all agree that Trump wants out and wants to declare victory so we can get on to midterms and preparing for that. But, you know, I think it's still a little too early to tell if things are okay. From the war aspect, it's too early to tell because I hear everybody parroting, oh, it's going to be great. You know, the Republicans, that's great. It's over. We won and blah, blah, blah. And the Democrats are like, blah, blah, blah. He's such a bad guy. And none of that is helpful. Okay. So everyone's saying everyone's pitching their book, but none of it's helpful as an investor. So I might be the only person who's going to tell you something that's helpful as an investor. Here's the thing you need to know. The markets were soft before the war. Okay. The markets were soft before the war. So all the war did was shuffle the pieces around a little bit. Now, I'm not saying we're in for a market crash. I don't know. But what I do know is, you know, the markets are pretty much within a trading range and they started to break down. Then the war happened and then they broke down for about a month. And now it looks like everything's hunky dory. But it's not. Nothing's really changed. Prior to the war, things were doing well. Energy, industrials, staples. Those are really the best three. Materials. Those are the best four. They were all doing great prior to the war. Since the war, everything's just kind of all different. Now, if you're a technical analyst and you're looking at charts, you're probably trying to discern a direction from here. It's been 3 days since then. Does that really dictate a trend? Now, I have two scenarios of what I think is going to happen in the markets. Scenario one is that we stay on the path of the old trend prior to the war, which was energy, industrials, staples, materials. Those continue to do well, which so happen to be the ones that do well at the top of a bull market, by the way. Those tend to do the best at the top of a bull market. So does that mean we have more to go? Maybe. But I would watch those areas to see how they perform in comparison to prior to the war. Not, hey, we bounced back from the lows, that doesn't mean anything because the lows were artificial based on the war, right? And the war has effects that aren't going to hit us quite yet. They might hit us in the next few months. So all those price increases, all those energy costs may not be felt across the board for a few months. So just keep that in mind. Some things are our gas prices for sure, but a lot of other things maybe not quite yet. So put a little pin in that as a TBD. But if you look at other things like, financials, technology, well, some of those areas weren't doing great prior to this, prior to the war. So the war didn't really impact it. So are they going up now? Yeah, a little bit because people are positive about tech, but I think it's still a little too early to tell, frankly. Software stocks are ugly. This has not helped them much at all. If I look at the software sector, just give me a second, let me pull it up. But if I look at the software sector here, if I'm looking at the IGV, which is the ETF for the software stocks, it's actually lower than before the war. So if you look at the last 3 days, it's actually gone down a lot. It's broke lower. It's just getting ugly in the software sector. So that's part of technology, right? Semis are also a part of technology, and semis have actually done reasonably well. So you look at the semiconductors. Let's look at the SMH, and I'm not showing charts, by the way. I'm just talking through it. It's back to all-time highs. Should it be? I don't think so, but it is. My views don't matter. So, and semis are pretty big part of technology, right? You've got NVIDIA, which is one of the biggest companies in the world, but you've got some other tech too. So you also have, prior to the war, you had interest rates, which were dropping. And after through the war, interest rates were going up. Does that mean that the new trend is interest rates are up or down? I don't know yet. What about the dollar, right? The dollar, which is what everybody talks about and nobody understands what it is. They just parrot what's on the news. Well, pretty much for the last year anyway, the dollar's gone from 100 down to, well, really a low of 95, but we'll call it approximately 96. The dollar's been in that range for a while. Now through the war, we hit 100 and change, $100.50, I think was the high point, and now it's down to 98. Does that mean a new trend started? Don't know. Now, there was a trend from February through April that the dollar was going up, but now it's broken down. So if you're a technician, you're looking at these and you're saying, all right, a new trend started, let's go with that trend. But if you expand the scope beyond just the technical analysis, you look at the fundamentals. Well, the fundamentals are also hard to predict because who knows what's going on with the war pricing and inflation, all that. So how do you read the markets? Well, the easy answer is I'll tell you what I'm doing. Everybody, you guys can do what you want, but what I'm doing is I'm taking a step back and I'm pausing. And I'm saying, you know what? I'm just going to watch and see what happens. I don't know what's going to happen. I have a feeling that some parts of the economy are going to continue lower and some parts are going to stay strong, which, was going on before the war, like software is going to keep getting weaker. Some parts of technology, I think, might get weaker. Some parts of financials might get weaker. Some of those areas might continue to happen, right? I don't know, but I'm not going to predict right now. It is way too early to predict. Trump just had a pause for 2 weeks. I have a sneaking suspicion sometime in the next week and a half, he's going to come out and say they were not reliable and we can't rely on, we're going to bomb the crap out of them again. And then they're going to bomb the crap out of them for a few days. And they're going to say, all right, they've come back to the table. We saw the same blueprint in Russia or Ukraine because we're technically not at war with Russia, right? And so we did the same thing with Ukraine. We did the same thing with China, although there wasn't a war, but, similar kind of strategy. Trump just does these things, right? He did it with the tariffs last year. They had the tariff tantrum. And they said, all right, it's over. And then the markets went up and they still tariff people, but the markets are like, all right, he's tacoing, whatever. He's chickening out. He didn't chicken out. That was his negotiation style. So now people are accustomed to it. The markets aren't selling off as much, but these things are still happening. So I would not place a lot of money on where the market's direction is going right now. Okay. There are certain things where the direction is irrefutable. One is software is not doing very well. That is pretty clear from the charts before, after the war, during the war. Pretty clear that's not doing very well. It's also clear that financials are having some issues. There's been some great interviews on the financial sector, mainly because of private equity or private credit, but also some of the banks and insurance companies, frankly. The whole financial sector, the big problem, the best description I heard was that, and I forget who said this, so apologies if I'm not giving you credit, but it was described this way, that the financial industry, the problems in financial industry are a combination of the size of the problem and the transparency of the problem. So let me explain it. So if you have $1 trillion of bad debt in the financial industry and everyone knows where it is, it's not a problem. But if you have 10 billion of bad debt in the industry and no one knows where it is, we've got a big problem. The reason is this: if everyone knows where the bad debt is, everyone positions around it. It's information everybody knows, so it's priced into the market. Everybody knows this is a problem. This company has the problem. We don't worry about it because we're not exposed, or if we are exposed, we get out. So everybody kind of positions around that. Okay. The problem is if there's like 1% of the exposure and no one knows where it is, everyone's positioning for the worst case scenario. And everyone's selling first and asking questions later. So the global financial crisis, granted, there was a huge amount of exposure. No one knew where it was. That was the problem. That's why we had such a big meltdown, because no one had any idea where this bad debt was. They didn't know it existed because of all the, chicanery that was going on. Nobody knew where it was. So if you have a small amount of problems that are non-transparent, it's a huge problem in the industry because people sell first and ask questions later. So that's something to keep in mind. And right now we know where private credit is. We don't know all the people that have it. And we also know there's a lot of window dressing going on. They're saying, oh, there's only 21% of exposure to software when there's really 30. So there's, 31, I think. Somebody's 31 and 32 is the most recent thing I heard. So, a lot of these things are a little bit in the weeds for most investors. But if you're not paying attention to this, it's a potential problem, right? So I think the financial sector has some problems, clearly. We don't know where all the bodies are buried right now, so I'm pretty clear from financials, but you can clearly see throughout before and after the war, if there's a trend in place, then that's a good thing. So for instance, the yield curve is flattening. That's been flattening since the war, which eventually leads to lower rates, or well, depending on what's going on, or higher rates. But we'll see what happens. But I think it leads to, let's put it this way. I'm going to share something after I give Doug a few minutes here about the oil markets. But the one thing you keep in mind is markets aren't just a today price. There's also a future price. Okay. So if you look at the yield curve, right, in the short end of the yield curve at 3 months, let's say it's for 3%. Let's say, I'm making up these numbers, so just because I don't have them in front of me. Let's say the 3 month is paying 3%, and then the 2 years paying 3.25%, the 10 years paying 3.5%, and then the 30 years paying 4%. Let's say that's the yield curve. That's a normal yield curve, positively sloped. It could be negatively sloped, which is where the short end is 5% and the long end is 4%. So that's an inverted yield curve, or it could be flat. We're all kind of the same rates. Right now it's positive, which means the banks do well, and they do really well in that environment because they can borrow short and lend long, and they make lots of money. When it's inverted or flat, it means banks aren't lending because they're not getting rewarded for that. So when you're thinking about that, and this is probably a different episode, the yield curve's flattening, so the banks aren't making as much money. So I don't like the financials right now. I think there's way too many problems, and there's so many other opportunities. You don't need to be in every sector, right? You can ignore some. They were doing well prior to forget when they stopped doing well, but they were doing well, and then they hit the skids right around the time people were talking about private credit, which was really January. January was the peak, and then it's kind of gone downhill from here. So, I would look at the market, see what the trends are, and just see if this post quote unquote war announcement is holding up or not. But it's okay to sit in cash for like a few weeks or a month or 2 months. It's okay. I know you get scared that inflation's going to kill your cash, but honestly, it's better than losing money. Because what if the war starts back up and the markets just drop 5 or 6% overnight? You're going to be mad. If it goes up 5 or 6%, you can be mad. Whatever. So you miss 5 or 6%. Just jump back on the train. If you want to think about the risk you're taking for the reward you're getting. Personally, I think that we're in a different situation than we were last year, and most people are equating it to last year with Trump's, taco and tariff tantrum and all this stuff, and he's going to repeat. It may rhyme, but it's not going to be the same. I think we've got another down leg to go before we continue up, and it could be a fake out. But anyway, point being is, don't be tied to what's happening today. Take a pause, take a step back, take a month off. Seriously, take a month off if you're trading or you're more active. Just sit in the sidelines. I'm not seeing anything obvious right now. I'm looking. I'm not seeing a lot of obvious plays. I think the best thing to do is just take your time. Pick sure things. Pick really, really obvious stuff. I'm not seeing anything obvious. Right? Don't try to make a trade happen. Don't try to make an investment happen. Don't try to buy something as it's dipping. Don't catch a falling knife, as they say. Oh, we can buy all these companies like Microsoft and these software companies because they're so cheap. What's your rush? Just wait, because they're getting lower. So why are you rushing to the table to light your money on fire? Most times when stocks plummet, they take some time at the bottom and then they slowly creep up. That gives you plenty of time. You don't have to rush it. So the lesson for today is patience and caution. Don't jump out of windows. Don't get greedy. Patience and caution. It's the best thing I could tell you right now. And I know it's hard to do because people feel like they need to be invested. They need to be having action. But since this announcement, I'm not doing a darn thing. I'm just waiting because I don't know enough to have an advantage. There's no advantage. I've been looking at every market I look at, and I'm not seeing any advantages. There might be one or two in there, but given the market conditions, if you can find one out of 500, it's probably not worth it because it means that the market itself is having problems and it could impact other things. Perfect example. In the war, utilities were holding up very well until one day they got cleaned out, absolutely cleaned out. They were down like 5% in a day for no reason whatsoever. Utilities are fine. They're like bonds. They just keep paying. And they got cleaned out in one day. It was stupid, but it happened. You can't argue with the price. People decided one day, hey, we're out of utilities. Okay. So, it doesn't matter what you're in. Just patience and caution. What are your thoughts, Doug? You're muted.
I think the patience and caution makes a tremendous amount of sense. And I think I want to tee up on one of the last things you said, again, about the regret of inflation. So many people spend their time talking, when things get really sour and really negative, then people tend to realize that they wish they had taken some sort of precaution. That is what we talk about. We talk about risk tolerance in the investing world, and every prudent fiduciary or advisor is going to work with a client, and if they're going to have investments and be involved with that, one of the first things that they have to find is what's your risk tolerance. And there's a number of different stupid phone. There's a number of different things that are used to do that. Some are just very simple questionnaires. Some people have come out with these really fancy algorithmic type of risk assessments. And there's no perfect science, because the reality of it is that people do tend to be more risk adverse than risk tolerant. They think that they are risk tolerant when the markets are calm and doing whatever they would like them to do when they're going up. And we have been on an extremely 90s-esque type of arguably irrational exuberance type of market expansion, especially over the last 5 years, with the exception of 2022, 23, the blip there, but really going back into the mid-teens. And with that, it is, it's kind of like some of the political rhetoric that we hear today that is very different than what we heard after 2001, right? After 2001, the country was coming together. We were worried about making sure that, we were protected, in America. And of course, now that we're, 25 years away from that, you listen to people around you, you start to hear like it's as if, that never happened and we don't have to worry. And, it's kind of gone out of people's minds. And, especially if those that were around at the time think about New York and how it all came together and how, of course, they talk about kind of what New York's like these days. So, and that's not the political point. It's an analogy to kind of look at that from a standpoint of markets, is that 2008 wasn't that long ago and it was catastrophic. It wasn't that many years before that we had the dot-com implosion, which was catastrophic. And that's why we had that lost decade, 2000 to 2013. I remind people constantly on here, as much as people talk about these great returns and, and you can hear people talking about 15, 20% returns on average, that the S&P 500, the darling that everybody these days, I guess, is just supposed to only invest in, was negative through 2013. And by 2018, it had only achieved a 5% annual return for those 18 years. That is more than a lost decade. That's a lost generation. For a lot of people, it's one of the critical working years. And so fortunately, many of them were benefited by the 90s, but gave a lot of that back over the next 13 years in terms of lost time. We go back to 1968 to 1982, stagflation era. Very similar. We peaked out at 14% inflation during that time and an average of about 0.6%, stock market appreciation per year. Egregiously poor for a 14-year period. That during that time, inflation was a real problem and was eroding the capital, eroding the ability to afford anything unless you had assets. Now, during that period, interest rates went up as well. They're tied they're very correlated, right? So you could get 18%, on your money market account during that period, but it still wasn't necessarily, and this is more going into the 80s, but it wasn't necessarily something that has ever been where cash paid similar to, exactly what inflation is, usually. So the point that I'm trying to make is that if you are sitting there having a comment about missing out on the markets, right? It is an awareness of that. Self-awareness would be to realize that if you go back to how you felt during those most catastrophic times, it's important to not forget that. That ultimately that is where right now a lot of these questionnaires are a little bit misleading because they ask you things about how you think you'd feel, and we don't have. We as humans are very poor at self-awareness. So we think that we feel this way and would feel this way until it happens. We think we're risk tolerant, but the reality is that we have a fear of missing out, and we become very risk adverse when the things happen. We think we're risk tolerant because because the risk right now, even though it's always there, isn't showing it's not rearing its head. So let's talk about that if you have that realization, you have that self-awareness, let's come back to the argument of, I don't want to sit on the sides because I'm going to miss out because of inflation. You're really missing out on a greed index. It's that fear of, hey, if it only goes up, what am I going to miss? But let's look at it from, like what you said, Kirk, an inflation standpoint. Let's say you had $1 million and that $1 million was sitting in cash. Okay. If I'm conservative, a little bit more aggressive on inflation. Let's say if I use a 4% right now, which is higher what they're reporting, but then again, we all know they don't report everything and that food's more expensive and things like that. So let's just say it's 4%. Okay. Over that next year, you would have an erosion of your purchasing power of that $1 million by $40,000. Now that sounds like a heck of a lot, right? It's 4%, eating into your $1 million. Now, if we break that down over a 12-month period, and you're talking about sitting out for a short period of time, for someone who has $1 million sitting out there, you're looking at about $3,000 a month in impact. Now, think of that on perspective again. That's literally looking at, for many, if you have $1 million sitting around in cash, okay, that might mean somewhere in the line that your mortgage is probably in this boat, maybe higher, maybe less. So you're talking about maybe 1 to 2 months of mortgage that you are costing yourself in inflation by being patient. But now let's look at the what ifs. If the market goes up, okay, if it goes on another rally and goes up, and sustains another double-digit 12% return this year, okay, so you missed on an annualized basis 4%, but now if we talk only a couple months, you missed maybe 1%. So you still had time to get in, and instead of getting 12%, maybe you got 11, maybe you got 10. Still a pretty fantastic year. But what if it goes down by 10 to 12%? If the markets drop by 10 to 12%, you effectively saved yourself 2 to 3%. You've saved yourself roughly $3,000 to $6,000 to $9,000. Okay, so the markets go two different directions, and we can't necessarily look at this as something to where we have to be in and capture it all the time. When there is no overwhelming amount of data that shows a clarity of what direction to go, sometimes the best direction to go is just to sit and wait it out. And that's exactly what Warren Buffett and, well, now the new CEO, that's what Berkshire Hathaway still continues to do. They've been saying this for a long, long time. And we talk, I mentioned irrational exuberance. The markets right now continue to be stretched at a point that where we are well ahead of valuations historically on PDEs. Now that pulled back a little bit, but yet when you start looking at data and where to get, things are still very, very expensive. So, from that standpoint, I just read something else where, again, some of the smart money is still continuing to sit on the sides. They're still looking at this, that although we've had a relief rally, there's, there's still this concern. Is it a wonder? We had betting in poly market that seemed to, once again, it's kind of the new reality, come in right around the same time that the announcements got made. Clearly, you can speculate all you want, but again, like you said, Kirk, if it comes out in a week and all of a sudden we're back at war, well, there's another betting opportunity. I hate to throw on your tinfoil hat, but when this continues to happen, there's clearly, things that are going on with the timing and announcements and who knows and what and why. You just start to have to, take that smell and wonder, hey, you know what? Maybe there's an electrical fire I need to investigate. Okay. The reality is that this is, you could rename Donald Trump, Donald J. C. Trump, Donald J. Capitulation. It's what he does. He's going to throw out the extreme like he did before, like everybody's going to die if we don't fix this. 2 days later, we have an agreement that everything's going to be great again. But is it really? We still have a massive choke point. We still have oil extremely high. It's still hovering, even though it's come back significantly. It's still hovering, close to $100 a barrel. So that has a rippling effect in everything that we do. The gas we put in our cars, the production, and we talked last week about how that was already affecting manufacturing, or countries where a lot of manufacturing occur in Southeast Asia. That takes time to get over here. So, ultimately, there is so much uncertainty that continues to come out of what's going on in these negotiations that you just have to be prepared for the fact that we are reacting to news, and news is nothing more than a tweet right now. That from a data standpoint, we don't have anything consistent to go by. Ultimately, oil, markets are rallying on this deal. Oil's still elevated. Everyone's celebrating this deal, but oil never went back to where it started. If the fear index is still very highly, around fear, and ironically, it's still less fear index than in 12 months ago. The markets have moved on. Oil didn't. Watch oil. Ultimately, inflation expectations are repricing right in front of our eyes. It's a live shift in probability. CPI expectations shifted from 2.8% now up to 3 to 3.5%. Massive one-day repricing inflation risk super volatility there. And guess what, Kirk? All of a sudden, we got rate cut optimism again at the same time, right? Because now we got a deal, but inflation expectations already moved higher. So while this market is celebrating all of this lower risk perceived, inflation expectations continue to be elevated. That is a relief rally into inflation reality. You mentioned, I'll turn this back to you but I did put there 6 charts that were defined the Q1 markets. I think they're a really good narrative to what we dealt with. Now, granted, some of that overlapped what happened in Iran. They only go through the end of March, but you could see, there was a broad erosion in a number of different areas, and it wasn't all spiked with Iran. A lot of it was just, systematic erosion over the 3-month period. But we still have, Kirk, we still have global damage there. Even with the rally, global markets are still showing stress underneath. And, the price recovered much faster than stability. To me, that is exceptionally, it is underline it right there. That is a reason to pause.
Yeah. No, I agree, Doug. So we're going to get some feedback. There we go. Yeah. So I want to talk through, there's some pieces here I think are really important. And I'm going to run through them here so I can share the screen. All right. So I want to talk through oil. And, everyone talks about oil, but I don't think people really understand oil. So I'm going to, Doug, I'm just going to ask you, what percentage of the world's oil do you think the U.S. produces? Based on what you hear in the media.
Based on what you hear in the media, I mean, we're in serious trouble. I think we probably produce 1%, and we rely heavily on the Middle East.
So who do you think the largest oil producer is?
Well, thankfully, I've been able to cheat a little bit, Kirk.
Based on what you heard in the media, Doug.
Based on what I heard in the media.
You're cheating. You can see my slides.
Right. Yeah. Well, you're not sharing them yet. Yeah. But yeah. I would say that it's definitely going to be Saudi Arabia. Actually, lately, I think it's probably Iran, Venezuela, Russia, BRIC. Definitely the OPEC nations are just choking us.
All right. Well, I'm going to share this and surprise you, even though you already know the answer. We are the world's largest oil producer. We produce 22.8 million barrels, about 22% of the world's total. The next is Saudi Arabia, which produces 11%, and then Russia, about 10%. Canada, about 6%. China, 5%. Iran, 4%. UAE and Iraq, around 4%. So I share this because you hear these knuckleheads and bobbleheads on TV talking, you'd think the world's going to end and, oh my God, we're not going to be able to heat our houses. And I will say that there are some countries that actually is a problem. And we talked about them last week. A lot of the emerging markets are the government offices are shutting down, or they're instituting some sort of rules to curtail the amount of energy use because they're running out. It's a real problem in many countries, just not in ours. In our country, we're fine.
I want to add something, Kirk, that is a surprise to me. You mentioned what would you think based on the news. The news and even a lot of the data out there has said how reliant China is on oil from the Middle East. But there's a tremendous amount of oil production coming from Canada, Iran, United Arab Emirates, and Iraq. And yet Canada is only slightly above what China can produce itself. And China actually produces more than Iran, which, again, because of a lot of the blockade, the word I'm looking for, the restrictions that we put on, makes a lot of sense. But UAE and Iraq producing less than China, that to me is a little bit of a surprise, because if you look at that, China is half the production of Saudi Arabia, which actually means China has more access to its own oil than I think people realize.
Well, let's talk a little bit about that. That was my next point. So China has I think it's 9 to 12 months of oil reserves. So China's not in the dire straits that people think it is. I know everyone on TV is like, oh, China's got the problems, and oh my God, they're getting all this oil from the Middle East. Yes, they do get a decent amount from the Middle East, and as Doug said, other areas. But China has plenty of oil. There are countries that are in trouble. China's not one of them. China has a lot a lot of reserves. It would take the war to go on for a while for this to happen. And of course, that's not going to happen. So China is not hurting for oil. Australia's in trouble. Japan's in trouble for for legitimate markets. But when you're talking about emerging markets, a lot more of them are. So we, when Trump hasn't really explained his reason or goals for the Iran war, so we're all kind of left scratching our heads and making things up. So in the spirit of making things up, I would suggest that one of the things Trump is doing is positioning us as like, hey, look at us. We got all this free energy. We got all this free oil and gas. Come get our gas, because, hey, it's available. Come buy it from us. I mean, we've got enormous amounts of gas and oil reserves and production. And, if you're shutting off Iran, well, it's not really Iran. It's the Strait of Hormuz, which is other countries as well. So it does impact the world, to be fair. But it's not like it doesn't exist. It does exist. We have untapped reserves we're not even touching because it's not expensive enough to tap. So I wanted to share that just because it's a little bit more realistic than probably what you're hearing on TV. I also want to share, if I can find it. Oops. Come on. That's not what I'm looking for here. Where is it? There it is. Okay. So I also want to share this. Okay. Now, what this is the futures markets for oil. Now, for those of you who don't understand this, I'm going to walk you through it. If you're buying oil, right, the price is, according to this, for the May, it's 112. I know that's not today, but that's as of when I did this, April 6th. So that was 4 days ago. So oil, the near term contract was trading at $112.28. Okay. Now, that's probably what you're seeing in headlines. It's all over the papers. Oh my God, it's 112. But what if you look a month out in June? Well, oil is only $97. And then if you look out in September, it's $77. And if you look out in a year, it's $70. Well, I don't understand. What's that all about? Well, let me explain it. Most, if not all, commodities are traded on the futures markets. Now, futures are a financial, I don't want to say security, but a financialized investment that trade on the futures exchanges that allow people to speculate on commodities with future expiration dates. So if you think of commodities as like a combination of options and stocks, they have a price and they're priced, but they're priced on a maturity. So let's say I'm a farmer, okay, and I'm planting my corn today. And then I harvest the corn in September, okay? So plant today, harvest in September. Well, let's say the corn price today is, I don't know, $5, a bushel, okay? And let's say the September one is $10 a bushel. Well, ideally, I produce it today. I should sell at the $10 because I'm getting more in September than I'm getting today. Now, as a farmer, I want to lock in that $10. Now, the price may go to $20, but I'm okay with 10 because I know what my costs are. I know what the outcome is. I'm going to net, whatever, $3 a bushel, and that's my price. Now, if corn goes up to $50, well, the farmer's going to be feeling really low for missing out on that. But there's an assurity that they're going to get that price no matter what, because the price could also go down to 5 or 4, right? And if their production cost is $5, then you're not making any money, right? So a lot of times producers of commodities will look out and say, all right, I have this amount of copper or corn or oil or whatever it is. I need to sell it. What's my best price? Well, I want to sell it in May, or I want to sell it in September, or whenever it is. And they lock in that price so that even if oil prices drop, they're still going to get that price. So look at Southwest. This is kind of something I had learned way long ago. So when Southwest started, when they initially started back, I think it was the early 2000s or late 90s, when they initially started, oil prices were in the toilet. I mean, they were like really, really low compared to other times. They locked in, I heard it was like a 50-year or 20-year contract for oil. So when they had gas for their planes, They locked in a really, really low price for like 20 years. So they could compete with all the competitors for 20 years. Now, after the 20 years, now they can compete with everybody else on the oil prices. But they locked in this really low rate and they're like, hey, let's go start an airline. We're going to make lots of money. Great idea, right? So if you look in oil prices, it's 112 now, but it's 89 in July and it's 77 in September and it's down in the 70s, next year. So what is that saying? That's saying that the smartest people in the world that are pricing oil, buying and selling the price of oil, they think that by May it'll be 112, right? By the end of May, it's usually I think second or third week in May when it expires. By that date, it'll be 112. I don't know what it is now, but let me actually look it up as we're speaking. So U.S. oil right now is at 98. Okay, so at 3 days ago or 4 days ago, it was incorrect because it's going down. In June, that was 97. Well, I would suggest right now that's probably going to be a little lower than 97. But this is how markets work. They price in future expectations. So as of this point in time, April 6th at 8:25 or 8:26 in the morning, Central Time, then the market thought these would be the prices at expiration date. Now, of course, these prices move, right, based on information that is constantly evolving. But if you like to price, so the point that I'm getting with this is when you see today's price, it does not mean that everyone is getting today's price. It means they might be getting today's price if they bought it today. But if you decided, well, I need a lower price, so I'm going to buy the September contract. So what that means is even if prices go higher, I'm still guaranteed to get $78 for oil. Now, obviously, if prices go a lot lower, you're still going to pay $78 for oil. So it's a game, right? It's a game of trying to predict the future. But I wanted to point this out because looking at the futures markets gives you great insight into what the market thinks prices are going to do in the future. Now, this only applies to commodities. It also happens to apply to indexes. So but if you look this up, and I'll try to share this next time, you see all the futures. There's a ton of them. There's currencies, there's indexes, there's softs as they call them. There's Bitcoin now or cryptocurrencies on there. You've got metals. You've got agriculture. You've got all these different things. And so when you're looking at this and you want to figure out what the future holds, this is what the market thinks. The market thinks that it's going to drop, by at that point like 40 bucks. Okay, well, it's down a lot. I wonder what it thinks today, and I'll pull that up for next time. But it's really important to look at so you understand how the oil markets work and how commodity markets work. Now, I did want to share that. We probably won't get into backwardation. Okay, so when I wrap it up with this, these are, as of a few days ago, these are the performance numbers for the last few months and for the quarter. And if you look here, the end of March, the best performing stocks were oil, gas, exploration, and services. Telecom, surprisingly, has done well. Commuter hardware, which is, pretty much, well, it's not semis, but that's surprising. But that's pretty much it. You look at the stuff that's not doing well: software, healthcare, equipment, insurance, partially because of the private credit issues, capital markets. A lot of areas are not doing well. Now, if you look at the areas that are doing well in the bigger sectors, energy is the best. It was up 37% in Q1. And then, the worst are financials, consumer discretionary, IT, communication, healthcare, and then the index itself. Utilities have done well, staples have done well, but I want you to look at this really closely, okay? Now, if you look at this, January and February, energy did really well, materials did really well, utilities surprisingly did well, consumer staples, I think consumer staples I thought they performed the best, but on this, it doesn't look that way. And then industrials, those are all the ones that did well, okay? Now, since the war happened, many of those have not done quite as well. Staples have not done, I think the staples are up like 16% or something crazy, and now they're only up 7. Industrials were up a lot. Now they're only up 4. Utilities were up like 10 or 11%. They're only up 7. And materials have reasonably held their own. They're up like 9%. But if you look at the energy market, I want to point this out. if you look at a chart of the energy market, and I'm not sure I'm buying into this 100%, but if I look at the energy market, if you look at a chart, if you look, you're like, wow, energy's done really well. The war really did well. But if you look at it when the war started to where it is today, it really didn't go up that much for start to the end of let's say pre-Trump's announcement, because that really took the wind out of the sails of energy markets. But if you look at that, and I'll see if I can pull up a chart for next time. But if you look at March, like basically March when they announced the war, it was the XLE was 57 at the peak. It was 63. Is that 5%? I mean, it says here 10. That's why I was saying I don't think this is correct. That looks like 5% for me. So it doesn't make a lot of sense, and it kind of scratched my head. I'm like, it doesn't really add up. But my point is for the war, energy markets didn't do as well as you'd think they would. I was kind of scratching my head, like, why aren't they doing better? So, I'm not a big fan of energy markets. I think there's money to be made, but I'm happy sitting on the sidelines for all that. So, Doug, you want to wrap it up? Take us home?
I will add one thing, and again, this is from the U.S. Energy Information Administration, but I don't know. Well, the overlap here. I just want to make sure I'm not dealing with a chart crime here. But they did look at oil price shocks, change of oil price in the first 60 days of a major political event of the 21st century, and I just posted this graphic out there. But interestingly enough, the different ones that they have start with COVID-19 pandemic, Great Financial Crisis, 9/11 attacks, Afghanistan war, same thing, Russia-Ukraine war, Iraq war, Arab Spring, and of course the U.S. Israel-Iran war. And as of April 2nd, and I got my screens blocked in front of me, they are showing that the U.S. Brent crude surged 80% since the start of the U.S.-Israel war in Iran on February 27, 26, largely due to the closure of the Straits. The second most was Arab Spring, which went up by a little over 20% over a 60-day period. What's interesting about the U.S.-Israel-Iran war is that almost 80% spike happened within the first 30 days. For all of these others, they didn't really jump the same degree. Now, the Russia-Ukraine war did. In the first 10 days, it jumped about 30% before it fell back down, almost flat, and then rose back over 20% before it declined and flattened out. Arab Spring was a steady decline, or a steady incline, up to a little over 20%. But it took 60 days to get there, and really didn't break 20 until roughly around 45 to 50 days. All of the other ones, 9/11 attack, Afghanistan war, actually oil prices fell. And Great Financial Crisis and COVID-19, kind of weird to have those on here because they aren't really. I think they're for comparison purposes, not really oil restriction events. I guess you could argue COVID-19 was an oil reduction event. I mean, we stopped manufacturing, so no surprise there that oil over the 60 days dropped down in price almost like 85%. And the Great Financial Crisis, which is just a normal thing when you have a recession, whether it's geopolitical enforced or it's a natural recession, things slow down, manufacturing slow down. I think if anything, that's a reminder there. As much as we look at the pump and gas prices, the reality of those two lines for Great Financial Crisis and COVID-19 is the fact that the majority of oil and impact on oil and demand on oil still flows through, which is why they don't have gasoline in inflation numbers as a separate category. It still flows through everything else. And ultimately, the biggest use of oil is the fact that it is in everything that we produce. And when I say everything, I mean everything. Just look at the dyes that are produced and put in food that are based off of petroleum as well. So anyway, I just thought that was kind of an interesting little thing to look at there. Otherwise, look, we are, I think that being patient, going back to that, is a very Smart is a smart thing for you to do right now. I think that we've had a lot of movement in these markets that are based off of not necessarily anything that we have immediately felt. A lot of it is based on the jumping of news here and there. Taking a step back, a week ago, markets were pricing extreme fear. Now they're just pricing fear, which I guess means they're pricing a relief, but it's the same system. It's the same risks. We still haven't necessarily seen the trickle down of the impact of this closure. We don't know if it's going to be permanent. That should tell you something. Markets don't move based on what changed. They move based on how people feel about what changed. And right now, confidence came back much faster than clarity. Oil is still elevated. Global systems are still adjusting to what just happened. Inflation expectations are continuing to shift right in front of our eyes. But the markets, hey, they're already celebrating. And that's where disciplined investors separate. Because when confidence returns too quickly, this creates blind spots. At Merchant Advisors, we don't just build strategies based on how the market feels in a given week. We build them based on structure, mapping everything, including income, assets, liabilities, taxes, college planning, and retirement income, and other cash flow goals. So their plan holds up whether these markets are fearful or whether they end up overconfident. Both can lead to bad decisions. And if you want to understand how you actually stand, not where the market says you stand, go to mergentadvisors.net. That's MERGENT, mergentadvisors.net, and start the conversation. Because in markets like this, the biggest risk isn't fear, it's believing that everything is fine all over again. We'll see you next time.
Awesome. Thanks, Doug. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.